Consumers are strong right now. They've got the cash, et cetera, Guy, but they haven't gotten 100 basis points yet to come in tightening, which they will probably get before not too long from now. And they haven't felt the full effects at all of any of the rate cuts that the Fed has made so far. So it's a very interesting dynamic. I'm grateful that the consumer is extra strong right now because we're going into an unprecedented amount of tightening to be felt.
Well, I always knew that Jamie watched Fast Money. Now I know that he watches it with the sound on because he's echoing a lot of the things that we've literally been saying, I want to say since November, probably longer than that. You know, the fact that he actually made reference to the fact that, you know, they eased for too long and they're late to the day, all those things. He's spot on. And I think, listen, the Fed officials probably realize that as well. And I'm not looking at dogpile on the rabbit here because we've done enough of that. But with that said, I mean, I happen to agree with what he's 2,900 is not ridiculous. We've said 3,400 is probably, that's fair value in this environment. And even if the Fed were to pause, pivot, stop, give different language to try to assuage some concerns, whether we're in a recession or not doesn't matter. And I will tell you, I'm sure it's infuriating to a lot of the audience out there that we talk about whether we're in one, not in one, because for a lot of people, we've been in it for the better part of a couple of years. With that said, we're absolutely in an earnings recession. And at a certain point, you're not paying as much for earnings as you were a couple of years ago. So what's the right multiple? We've played the game. Dan mentioned it. I think Savita put a $200 price target in terms of EPS for the S&P. 15 multiple on that's 3,000. It gets you right to Mr. Diamond's level. So you look at the HYG, I think it was a 15-year low today within a couple points. LQD levels we haven't seen since 08-09. None of this is particularly good. I will say this. It is good news that once again the VIX is pushing up to 34 because every time we seem to get there, the market seems to short-term bottom. So we'll see how it plays out.
I mean, the timing, as Karen had mentioned, is very interesting, given this is the first full, big, giant week of earnings, particularly for the bank earnings. And so, Karen, I wonder, from your standpoint, do you think that the bank stocks, and maybe specifically J.P. Morgan, have actually priced in what Jamie Dimon himself is forecasting?
I mean, I haven't seen, I think it's priced in quite a bit. I think it's priced in, net interest income, I think, will be okay. It's priced in not great loan growth, and it's pricing in a disastrous investment banking, capital markets. Some capital markets will be okay, but I mean, the amount of issuance is down so dramatically. So it's pricing in that, even though those are lumpy kind of earnings. And I think it's pricing in some credit erosion that I don't think we're really going to see yet. So, I've thought this for a while, though, and, I've been wrong. The stock was much higher. But at this valuation, 8 times, 3 dividend, the stock needs to trade down every time they report, regardless of how good or bad it is.
Right.
But
right.
I'm long, staying long. I have a bigger position in Bank of America, but I'm definitely long banks.
Yeah, actually, I agree here, and I do want to look at the banks as an opportunity, and they are so cheap right now from where they've been. And yes, they have. We would have said that a while ago, and they've gotten cheaper. But banks too do tend to be those companies that go down the hardest as we're going into a recession, but also as things are improving, they also tend to be the ones that improve the most. So if you are of a mindset here that some of this is getting priced in, and I do think we're close to, if not there, on the bank earnings, then I do think that this can be an opportunity over the long run.
Yeah, it's of course the guidance.
Yeah.
And based on what Jamie Dimon said, the guidance probably won't be that great.
I think that's the key. I mean, he's not going to really change his tune. And when you think about what the outlook is for, again, for consumer balance sheets, it seems like that's the thing that everyone keeps kind of resting on a little bit. But we know, I mean, that's just not going to get that much better here. And we already know if retailers are already starting to think about how accommodative they can be right in front of the holiday season, I think they're really weird. Or, we've seen this now for months, what Target and Walmart have had to say to us about consumers trading down. So that doesn't really speak that well, especially when you're seeing gas prices have been really sticky here. Inflation readings are really hot. I mean, listen, at the end of the day, I mean, I think that the stock market, to your point, is like it will bottom at some point before we have a recession. To Guy's point, we are in an earnings recession. So it's the disconnect between what the markets are doing and what the economy is doing. And if you're trading the markets and you're investing in the markets, focus on the markets. To Guy's point about the VIX at 34, if we get another leg lower back to 3,400, the VIX is going to be at 40. What will that tell you? It's going to be a really good time to maybe take off shorts. And a lot of our viewers don't short things or whatever. but then start to add to long, start dollar cost averaging on your way to maybe being down 40 or 50% from the highs. That's the only way to do it, because no one's going to ring the bell at the bottom.
Yep.